The term volume refers to the total number of positions that have been opened during a given period of time. The term liquidity refers to the level of rapidity with which an asset can be either bought or sold at its current market price. Volume and liquidity are considered interrelated because the trading volume is an indicator of the total liquidity in an asset. A higher trade volume indicates a greater overall market interest for a particular asset, as well as an indication of a high liquidity level. Assets with higher liquidity are getting traded more frequently and more rapidly than the ones with lower volume. A lower trade volume indicates a low overall market interest. Low volume assets are being traded less frequently, and therefore have a higher volatility. The volume of the price can be analyzed through the shadows of the candles, often found at resistance and support levels, indicating new volume of orders for a potential reversal. Liquidity is simply the total number of volume active in a given asset. Volatility, on the other hand, represents the speed of price movement. Once the volume of an asset establishes a winner between bulls and bears, it will therefore accelerate in an upward or downward direction, which is defined as the volatility of the price. When the prices of interbank quotes change quickly, it means that there is a phase of high volatility. The highest level of volatility occurs when fundamental news are released. High liquidity allows traders to open and close positions very quickly. This happens because there will always be someone with an opposite position, which will generate the necessary liquidity to be able to close the position. The Forex market is the most liquid market in the world, and any position can be closed instantly. The higher the liquidity, the lower the volatility. The lower the liquidity, the higher the volatility. Liquidity directly affects the technical analysis of a given asset. High liquidity allows the price to correctly reflect technical patterns, while low liquidity does not allow the price to move correctly, creating confusion and having to rely mainly on fundamental analysis. Between the 15th of December and the 15th of January, the Forex market suffers a drastic loss of liquidity due to a sale of securities by companies and banks in order to reach their annual objectives, together with a lower general activity due to the Christmas holidays. This leads the Forex market to dry up and to have a loss of orders, which cause the price fluctuation to increase, becoming unpredictable and unreliable in some situations. At this specific time of year, it is recommended that you avoid or minimize your risk percentage. Another situation in which a lack of liquidity may be encountered is on Fridays from 3 p.m. onwards, before the weekly close of the price. The Forex market, as mentioned above, is the most liquid market in the world. This means that it is the most stable market today, and one that most reflects the technical patterns of all financial markets. The overall liquidity in the Forex market guarantees reliability and trust in traders. It is difficult to manipulate the Forex market, unlike other markets, thanks to the large liquidity it possesses.